Welcome to Life Insurance Basics, Types and Cost Relationship. My name is Greg Durrett, and I'm with Future Secured Financial. We're going to talk a little bit about what all these different life insurance types are and exactly how they work when it comes to your cost. A big thing. Thank you for listening, and we're going to get after it right now. So what types of life insurance are most common? I get this question all the time. A lot of times folks are just confused saying, hey, geez, I know I need life insurance, but it's so confusing. There's so many different things. I hear this from that one and the other one. So what direction should I go? Well, first, you have to know what you're dealing with. Well, there's term insurance. There's universal life insurance. Whole life insurance. Those are your basics. Term insurance. It's the cheapest. We're going to go escalating up in cost through this presentation. So understand that at the beginning, it's going to be less. And when it comes to the end, it's going to be more. Don't worry, I'll remind you. Features of term insurance. Well, again, it's the lowest cost you can get. Usually a fixed cost for a fixed term. Now, what does that mean? Well, it means that, you know what? Well, if you want to have an amount of money paid out to your beneficiaries, well, it's going to be picked what? At some face amount. 100,000, half a million, million, whatever. You want to fix that cost in term insurance. So you can buy it where the cost is guaranteed for 10 years or 20 years, 15 years, 30 years, 25 years. Usually no less than 10 and no more than 30 years. Now, does the insurance continue thereafter? Of course it does. But the cost is enough to make you need the insurance. It goes way out of whack after you exceed it. So the key here, if you're going to buy term, make sure that you're buying it for a period of time that is sufficient to cover your term of need. You're not going to want to pay the rate after it expires. Now, there are certain things called convertibility options which will allow you to convert to a permanent product within a company, depending on the company and depending on their term conversion process. It's a good thing, but you have to make sure that you're buying something that you know all the ins and outs of, and you don't want to ever have to say, "Oh, I'm 40 years old now, and I'm going to buy a 30-year term that'll get me to age 70, and I'll worry about that after if I make it to 70." Well, guess what? If you do, you're going to have to go through the whole process again with the age and stage that you are. I guarantee you two things are going to happen. You're going to get older and you're going to die. What's likely going to happen when you get older, though, is you're probably not going to get healthier. So that means your insurance is going to be exponentially higher. You don't want to go down that road. So make sure you're buying the right amount of insurance for the right amount of time to take care of what it is that you need, and you're at peace with the fact that you're going to end up having to give it up at a certain point. It is a highly, highly, highly competitive field. The rates vary tremendously between companies, and they change on a regular basis. Just because you got a price from somebody today doesn't mean that's going to be the same price tomorrow. It is a very, very high commodity, if you want to look at it, based type of product. And it is an excellent solution if you have a short-term need for a particular amount of coverage. A lot of times people will use this for covering stock market losses, because all of a sudden, well, hey, look at, you were in the market and you lost $500,000 in the market. And that was supposed to be money that your heirs would have if you were to die before you had a chance to try to make that money back. Well, you know what? Great Band-Aid. Take term insurance, buy a short-term policy, and get yourself covered while you're still trying to build up that asset. Because really, insurance is what? It's renting an estate you haven't had time to build. So build it with term insurance. Now, there are cautions. Like I said, the end of your term doesn't mean the end of the policy. It means the end of the guaranteed low premiums. They can be confusing convertibility options. You have to be sure that you understand those if that's a potential consideration for you. The face amount is fixed. Now, sometimes the carrier will agree to go lower during the term of a policy, but they will never, ever agree to go higher. Underwriting does vary greatly, and I think that this particular caution can go across the board. Just about every product that we're going to talk about, the underwriting matters based upon the amount of insurance you're buying, the type of insurance you're buying, and which insurance carrier you're using to buy it. There is no cash value. So when you're spending your money on insurance, you're spending your money on insurance, and that's simply the way it is. It is a low cost, but a pure transaction in that you're paying for something that you will not get anything out of personally, but your heirs will. Universal life insurance is different. It is a moderate cost. It is adjustable. When you say, what? I say, yeah. I say adjustable means that you can change the premium. You can change the face amount. Now, when I say you can change the premium, everybody says, yay! Let's make it 0. Okay, good. Unfortunately, that's going to make your coverage go to 0 too. But you can adjust your face amount up and down. Now, it's particularly useful. Think about it in terms of this. Let's say you're 35, 40 years old and you have kids going off to college. Well, now you know you've got maybe 2 or 3 kids. You've got an unfunded liability now of maybe anywhere between $100,000 per kid to $250,000 per kid going to school. Well, that's almost $1 million. That's $750,000. Well, guess what? You can go out and get that universal life insurance policy for $750,000. And as each child moves through a stage of exposure in college costs, you can adjust your life insurance face amount down, which will lower your premium. So you actually have the ability to play with that to the point where you're able to control your costs as your cost expenditures are cycling through. It's a pretty powerful thing. So it's considered permanent insurance, but you need to make sure that it's properly funded because it is cash value sensitive. If you don't give it enough money and the cash value goes to 0, so too does your coverage. It is very, 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 very competitive. It is something where you really need to get out there and find out what's going on. Get a good broker. We're good brokers, by the way, that can help you find what is going on currently in the marketplace and get you exactly what it is that is the best fit of coverage, security, and pricing. So it's very good, like I said, for long-term, flexible needs. Now, what do you need to be aware of? Again, if you underfund it, it could lapse. That is a bad thing. You don't want to have to go through this whole process, put thousands and thousands and thousands of dollars into it, and have it not have been enough, and then 10, 15, 20, 30 years later, find out that your policy is about to lapse without a gigantic injection of cash. Not good. So confusing interest strategies on certain varieties, they can sometimes be a little bit thick, sometimes they're indexed, sometimes they're all sorts of things all over the board. You need to make sure you understand what it is that you're buying. Again, underwriting varies. And there is optional cash value. Cash value is very powerful in these things because here's what you can do with cash value in these types of products is you can actually build this instead of just as a life insurance product, you can build it as also a retirement product. Because if you build it big enough, you're getting tax-deferred growth, you're getting very competitive growth, depending on the product again, and you're also getting this thing that you can do called tax-free distributions. Ooh, everybody's ears just perked up. Tax-free distributions mean that you can actually give yourself your own cash value back tax-free if you do it the right way. We know how to do it the right way, and we can teach you how to do that so that you can actually use this to do 2 things. It covers your life insurance exposures, but it also covers your retirement exposure as well. Very powerful tool. Universal life insurance comes in 3 varieties. You get the guaranteed, fixed, cash value, fixed, and you have variable. All right, let's look at this one first. Guaranteed fixed means it's guaranteed not to lapse. It will not, and you get to dial in exactly how long you want that policy to go. You can do 85, age 80, 85, 90, 100, all the way up to age 121. And of course, the longer you guarantee that premium, the longer what? Or the more what? The more it's going to be. So the longer it is, the more it is. All right. The guarantee is that the premium won't increase. This is almost like term insurance that doesn't expire because it does not accumulate cash value on a long-term basis. So within a few years, you're going to be at 0. And like I said before, most universal life, if you're at 0 with cash, you're at 0 with coverage, not with these. So this is the next step up from a term policy. If you're 40 years old and you don't think 30 years is enough, you think, well, I got longevity in my family, maybe I need to go to age 105 just to be on the safe side. All right, this is your answer right here. Again, highly competitive, and it is an excellent, excellent solution if you want to go longer term than what you can get in a term insurance policy and not be worrying about cash value accumulation. All right, Cash value fixed means that it's going to give you a lot of cash value if you fund it what? The right way. All right. So there's a bunch of different interest strategies, like I said before, but you got to make sure you're paying attention. You have to pay attention because you do not want to pour, like I said, thousands of dollars into it and have it go away later in life. It is a tremendous tool for businesses to use when there's buy-sell agreements in place, that you can dual set up your company to make sure that not only if death occurs, you're funding the buy-sell, but also it's funding the retirement buyout of the partner. And it's also a great estate planning tool because we're not going to get into the weeds here, but you can get into a lot of very deep estate planning scenarios with trusts and all sorts of things where these types of products work exceptionally well. Variable. You know my proclivity to not like variable things because they end up not being dependable. Market-based products, so they claim that they're going to have a lot of increase in money, yeah, but they also have risk of loss too in many cases. You need a securities broker. That means that it's a risk of loss. And that's not my determination. That's a determination of the Supreme Court that says, hey, look, at anything that has a risk of loss is a securities product. So you have to have a securities license. We don't sell these because we don't like risk of loss type stuff. All right, so we're out of that. Whole life insurance. All right, whole life insurance. What are the general features? Everybody knows about that. It is simply the most expensive choice, but it's a fixed premium and face amount. So you can get variable face amounts on these, but most times it's very fixed. It's reliable. Very reliable. You're not going to have to worry about the interest rate environment. You're not going to have to worry about your premiums maybe going up some point in the future. You're going to be able to just rely upon that product. It will not lapse so long as you pay your premium. Strong and predictable cash value. Now that means that it's going to be okay. It's not going to be huge. You're not going to be slamming, your hand on the desk going, wow, look at what a hit I had today in the market. No, it's just going to be very strong, stable, steady goes the course, and it'll be a predictable type of thing where you can look to the future and know what you're going to have. Again, very competitive based upon the interest rate environment of the various companies, and so it is a strong, strong, strong product that you want to have with a strong, strong, strong carrier. Now, it is a good, really good thing for long-term stuff. So you want to make sure that if you have an estate plan that needs to be funded, or you need to do some of the more higher level planning that needs to have ILITs, for instance, irrevocable life insurance trust, things like that need to be funded in particular ways, this is the product that's the go-to. All right, so the cost is high, and if you're not prepared for it, it might be difficult to maintain later in life, or if things happen. If you're scraping by, this is not your product. All right, because if you lose your job or you have to adjust, you're not going to be able to keep making these payments, and it's something that you don't want to go deep into and then lose. A lot of interest strategies are out there. It makes it kind of difficult to understand. Make sure you understand the ones you're in. And again, underwriting. All right, so two varieties of these, fixed and variable. Guaranteed to be there on the fixed side, of course. You're going to have a fixed premium, fixed face amount, strong, predictable, and it's inflexible. Doesn't move around in most cases. So you're not going to be able to adjust things. All right, again, same, it's almost like I'm stuttering, but it's repetitive. Again, on the variable side, they're market-based. They require a broker. It's just risk everywhere you go. So these are your life insurance basics, all right, and how the costs play into all of them. My name is Greg Durrett with Future Secured Financial. I'm actually the founder of this company. Been doing this for 33 years and would love to be able to help you sort through some of the clutter and get you what it is that you need to take care of your family and your estate. Thank you very much.